The smart money knows what's coming. While institutions quietly distribute their holdings to the eager public, they repeat the same fatal phrase. This time is different, but the tape never lies. Volume tells the real story, massive buying from uninformed traders at precisely the wrong moment, while composite operators silently exit their positions. Every major crash follows this identical pattern of deception. Example in practice. Picture March 2000's analysts proclaimed the new economy had eliminated old valuation rules. Yet accumulation had ended months prior. Distribution was clear, climactic volume on nominal price gains, followed by automatic reactions. The composite man was selling everything the public desperately bought. 6 months later, fortunes evaporated. The lie, fundamentals don't matter anymore. The truth was written in the price-volume relationship all along. Let me explain something I've observed countless times in my years of studying the market. The most dangerous period for the uninformed trader is not when prices are falling, but when they appear strongest just before the fall. This is the distribution phase, and understanding it separates the professional from the amateur. The composite operator, and by this I mean the large interests who actually move markets, has completed his accumulation at lower levels. He has marked up prices through a systematic campaign. Now he faces a problem. He holds enormous positions that must be liquidated. He cannot simply dump these shares onto the market. There wouldn't be sufficient buying power to absorb them without collapsing prices immediately. So what does he do? He creates conditions that attract the maximum number of buyers at the highest possible prices. Watch the tape carefully during this phase. You'll observe something peculiar: tremendous volume with little corresponding price advancement. The public sees this activity and interprets it as strength. "Look at all that buying!" they exclaim. But is it buying? I've learned to read these signs differently. When volume expands dramatically yet price makes only marginal gains or moves sideways, someone is absorbing all that enthusiastic public demand. The composite man is methodically feeding out his holdings to eager buyers who believe the advance will continue indefinitely. The newspapers and tipsters, whether knowingly or unknowingly serving the large interests, proclaim the market's strength. Brokerage houses issue bullish research. Everything appears magnificent on the surface. This is precisely the deception. The composite operator requires this optimism to complete his distribution. He needs believers, not skeptics. He needs volume, not hesitation. I've developed specific tests for identifying this phase. First, examine the price-volume relationship. Are we seeing climactic action, explosive volume with minimal price progress? Second, observe the character of rallies. Do they occur on decreasing volume? Third, note the selling waves. Even small declines often show increased activity, indicating supply overhanging the market. The most revealing characteristic is this: after sharp upward thrusts on heavy volume, prices fail to hold gains. This is the automatic reaction I've written about extensively. It demonstrates that genuine demand has been satisfied. The professionals have sold to the public at the top of these movements, and when that buying pressure dissipates, prices naturally react downward. Understanding distribution protects your capital. When you recognize that strength is often manufactured to facilitate selling rather than representing genuine accumulation, you avoid the fatal mistake of buying at precisely the wrong time. The tape tells you everything if you learn its language. Volume is not inherently bullish or bearish. Context determines meaning. During distribution, heavy volume represents transfer of ownership from strong hands to weak hands, from informed operators to uninformed speculators. This is the foundation of my method: reading what is actually occurring beneath surface appearances, understanding the motivations of those who control supply and demand, and positioning yourself accordingly. I want to address something that has troubled me throughout my career: the dangerous stories that circulate when markets reach extremes. You see, the composite operator understands human psychology far better than most traders realize. He knows that people don't simply buy stocks, they buy stories, dreams, and justifications for their actions. Before every significant decline I've witnessed, there emerges a narrative that effectively neutralizes rational analysis. These aren't random occurrences. They serve a specific purpose in the distribution process. The large interests need the public to continue buying with enthusiasm, even as technical conditions deteriorate. How do they accomplish this? By replacing objective tape, reading with compelling narratives that excuse away warning signs. Listen to what they tell you during these periods. The old rules no longer apply. We've entered a new era of permanent prosperity. Traditional valuation methods are obsolete. This market is different from all previous markets. I've heard variations of these statements before every major top. They're remarkably consistent across decades because they work. They give the uninformed trader permission to ignore what the tape is clearly showing. Let me be direct about this. There are no new eras in speculation. Human nature doesn't change. The laws of supply and demand don't change. The necessity for the composite man to accumulate low and distribute high doesn't change. What changes is merely the story used to disguise these eternal principles. The insidious aspect of these narratives is how they specifically target the technical warnings you should heed. When you observe that volume is increasing while prices stall, a classic distribution signal, the narrative provides an alternative explanation: consolidation before the next leg higher. When you notice weakening momentum and failed rallies, the story soothes your concerns. Healthy profit taking in a strong bull market. Every technical deterioration gets reinterpreted through the lens of continued optimism. I've learned to recognize when Wall Street's narrative machinery shifts into high gear. The research reports multiply. The newspaper coverage becomes uniformly bullish. Brokerage firms host seminars explaining the new paradigm. Experts appear everywhere assuring the public that conventional analysis is outdated. This coordinated message serves the distribution process by maintaining demand while large operators liquidate. The most effective protection against these narratives is developing confidence in your own tape reading ability. When you've studied enough market cycles, you recognize that price-volume relationships don't lie. They can't be manipulated by storytelling. A stock that rallies on decreasing volume and declines on increasing volume is under distribution, regardless of what narratives explain otherwise. I've built my entire methodology on this principle: stick to what you can observe and measure. Price movement and volume are facts. Stories about new eras and paradigm shifts are opinions designed to influence your behavior. The composite operator profits when you abandon technical discipline for narrative comfort. He loses when you remain focused on what the tape actually shows. Your success as a trader depends on distinguishing between observable market behavior and the stories constructed to explain that behavior. Trust the former. Question the latter relentlessly. The tape reveals truth. Narratives often conceal it. Now we come to what I consider the most critical and most misunderstood phenomenon in the entire distribution process: the buying climax. I've watched countless traders lose fortunes because they misinterpreted this action. They saw dramatic upward movement and enormous volume and concluded, "This is it! The big breakout!" When in reality, they were witnessing the composite operator's final and most profitable distribution opportunity. Let me describe what actually occurs during a buying climax. After an extended advance, after weeks or months of rising prices, there comes a day, sometimes several days, when the stock explodes upward on tremendous volume. The move is spectacular. It attracts attention from every quarter. Traders who've been cautious suddenly feel they must participate or miss the opportunity of a lifetime. The newspapers trumpet the advance. Brokerage offices fill with excited customers. This is precisely what the large interests have engineered. Think about this logically. Who is doing all this buying? The public, certainly. They're rushing in with both hands. But in every transaction, there's a buyer and a seller. For all that enthusiastic buying, someone must be selling in equal volume. Who possesses enough stock to sell into this ravenous demand? Only those who accumulated at lower levels. Only the composite operator who has been patiently waiting for exactly this moment. I've studied these climaxes extensively, and they follow a consistent pattern. The volume is out of proportion to the price advance. Often the heaviest volume of the entire move occurs on the climactic day or days. This tells you something crucial: absorption is occurring. Vast quantities of stock are changing hands, transferring from strong, informed holders to weak, uninformed buyers who are acting on emotion rather than analysis. The psychological element is essential to understand. The buying climax doesn't occur at the beginning of a move when smart accumulation happens. It occurs near the end, when the last skeptics capitulate, when those who've watched from the sidelines can no longer resist, when the fear of missing out overwhelms all caution. The composite man has anticipated this psychological moment. He's created the conditions for it through the entire markup phase, and now he exploits it ruthlessly. What follows the buying climax? I call it the automatic reaction, and it's as predictable as sunrise. Once that panic buying exhausts itself, and it always does, prices react downward. There's no longer sufficient demand to support the elevated level. The professionals have sold out. What remains is a market top, heavy with inexperienced holders who bought at the worst possible moment. Here's how you protect yourself when you see explosive upward movement on unprecedented volume, especially after an extended advance. Resist the impulse to chase it. Ask yourself, if this were genuine accumulation by large interests, would they advertise it with spectacular price action? No. They accumulate quietly on reactions when public attention is elsewhere. Climactic action represents distribution masquerading as strength. I've developed this principle through decades of observation. The most dangerous time to buy is when it feels safest and most exciting. The buying climax creates that exact feeling, and that's precisely why it's so effective at trapping the uninformed. After the initial weakness appears following distribution, Wall Street faces a delicate situation. The public has begun to notice the decline. Concern is creeping in. Some holders are considering selling. This is where I've observed one of the most consistent deceptions in all of market manipulation: the promotion of healthy corrections and excellent buying opportunities. Let me walk you through what's actually happening during these secondary movements. The composite operator has completed his major distribution at the top. Prices have reacted downward, the automatic reaction I mentioned earlier. Now comes a critical test. Will the public panic and dump their shares, or can they be convinced to hold and even buy more while prices continue their ultimate descent? The large interests understand they may still hold some inventory to liquidate. More importantly, they want to prevent a disorderly collapse that might attract regulatory attention or create conditions unfavorable to their next campaign. So they engineer what I call secondary tests or rally attempts. These movements serve multiple purposes, all beneficial to the composite man and detrimental to the uninformed trader. Watch the character of these rallies carefully. This is where your tape-reading skills become invaluable. Compare them to the rallies that occurred during the genuine markup phase. You'll notice stark differences. The volume is lighter, much lighter. The price gains are smaller. Most revealing of all, these rallies consistently fail to reclaim the previous highs. Each successive peak falls short of the last one. This is not coincidence. It's the signature of a market under professional distribution. I've trained myself to recognize the quality of rallies versus the quality of declines during this phase. When prices decline, volume often increases. When prices rally, volume diminishes. What does this tell you? It tells you exactly where the preponderance of genuine interest lies. Selling pressure is real and sustained. Buying interest is tepid and temporary. The composite operator may support minor rallies to facilitate his final distribution, but he has no intention of resuming the advance. Yet, during these very periods, the financial press and brokerage recommendations often turn most bullish. Buy the dip, they proclaim. This pullback is your second chance. Strong support has been established. I've seen this pattern repeat so many times it would be amusing if it weren't so destructive to uninformed capital. These recommendations serve the distribution process by providing buyers for the remaining inventory the large interests need to liquidate. Here's the test I apply, and I suggest you adopt it after any significant decline from a top. Watch the first rally attempt with extreme skepticism. If it fails to reclaim at least 2/3 of the prior decline on volume comparable to the advance phase, assume distribution is ongoing. If the second rally attempt shows even weaker characteristics than the first, you have confirmation. The composite man is not supporting higher prices. He's using each rally to complete his selling campaign. The failed rally is actually a gift to the observant trader. It provides definitive evidence of the large interest's intentions. They're telling you through their actions, not their words, but their actual market behavior, that accumulation has ended and markdown has begun. Ignore the soothing narratives. Trust what the tape reveals through these progressively weaker rally attempts. I want to address what may be the most pernicious lie perpetuated in financial markets. The notion that crashes are unpredictable, acts of God, or unforeseeable calamities that strike without warning. This falsehood serves the composite operator beautifully because it absolves him of responsibility and keeps the public ignorant of readable market structure. But I'm here to tell you, after decades of studying markets, that this is categorically untrue. Every significant market decline I've witnessed, and I've witnessed many, announced itself in advance through the tape. The progression from accumulation through markup, distribution, and finally markdown follows identifiable laws as reliable as any physical law. These aren't mystical patterns visible only to gifted seers. They're concrete, observable phenomena available to anyone willing to study them seriously. Consider the complete cycle. During accumulation, the composite operator absorbs all available supply quietly, typically after prices have declined substantially and public interest has waned. The characteristics are unmistakable: buying on declines, narrowing price ranges, decreasing volume as supply is absorbed, and springs or shakeouts to acquire final shares from weak holders. This phase happens below the public's radar because it's designed that way. The markup phase follows, characterized by higher highs, higher lows, and increasing volume on advances. This is when the composite man encourages prices to rise. He wants public participation now because he needs buyers for his eventual distribution. The rally appears natural and sustainable because it is genuine in the sense that the large interests are supporting it. Then comes distribution, but which we've discussed extensively. But here's what's crucial: distribution doesn't happen suddenly. It unfolds over time with clear warning signals. The buying climaxes, the increased volume without corresponding price progress, the weakening momentum, these signs appear methodically, often over weeks or months. They're visible to anyone watching the tape with trained eyes. I've developed specific tests for each phase transition. When accumulation shifts to markup, you'll see a sign of strength, a decisive move upward on expanding volume that breaks through resistance. When markup transitions to distribution, you'll observe climactic action followed by automatic reactions. When distribution completes and markdown begins, the failed rallies we discussed provide confirmation. The black swan narrative, this idea that crashes appear from nowhere, protects institutional operators by discouraging the public from learning to read these transitions. If traders believe crashes are unpredictable, they won't develop the skills to anticipate them. They'll remain dependent on the very sources that benefit from their ignorance. Here's what I've learned through careful study: the market is not random. It's not chaotic. It's controlled by large interests operating according to consistent principles. They must accumulate before they can mark up prices. They must distribute before they can mark down. These aren't choices, they're necessities imposed by the size of their operations. Your protection lies in understanding these phases and recognizing the transitions between them. When you see distribution characteristics appearing after an extended advance, you know what's coming. When you observe failed rallies and increasing supply, you have confirmation. The crash isn't unpredictable, you simply weren't reading the warnings. I've built my entire approach on this foundation. Markets tell you what's coming if you learn their language. Stop accepting the lie of unpredictability. Start studying the laws that govern market behavior. The transitions are always visible to those who know where to look. Let me bring all of this together for you. The lie Wall Street tells before every crash, "This time is different," or that markets are unpredictable forces of nature, isn't told out of ignorance. It's told with purpose. It serves to keep you buying when you should be selling, holding when you should be exiting, and hoping when you should be protecting your capital. I've spent my career studying the methods of the composite operator, not because I admire deception, but because understanding these methods is the only way to protect yourself from them. The large interests aren't your enemies simply because they're large. They're operating according to their nature, which is to buy low and sell high on a massive scale. Your disadvantage comes not from their size, but from your ignorance of their methods. Everything I've shared with you today, the distribution masquerading as strength, the narratives that replace technical analysis, the buying climaxes that trap the unwary, the failed rallies that confirm intentions, and the readable phase transitions, these aren't abstract theories. They're practical observations drawn from actual market behavior. They repeat because human nature doesn't change and the mechanics of large-scale operations don't change. Here's what I want you to understand: you have a choice. You can continue accepting the conventional wisdom that crashes are unpredictable, that you need experts to guide you, that the little guy can never compete with Wall Street. Or you can dedicate yourself to learning the language of the tape, to reading price, volume relationships, to recognizing the signs of accumulation and distribution. The tape doesn't lie. It can't lie. It's a record of actual transactions between buyers and sellers. When you learn to read it properly, you gain an advantage that no narrative, no expert opinion, no Wall Street promotion can take from you. You see what's actually happening rather than what you're being told is happening. I'm not suggesting this education is easy or quick. I've devoted decades to perfecting these methods, and I still learn from every market cycle. But the alternative, remaining dependent on sources that profit from your ignorance, is far worse. Every dollar you lose to a crash that nobody could have predicted is a dollar that transferred from your pocket to someone who absolutely did predict it and positioned accordingly. My final advice to you is this: become a student of the market, not a gambler. Study the complete cycle from accumulation through distribution. Practice identifying these phases in real time. Keep records of your observations. Test your interpretations against subsequent price action. Develop confidence in your own analysis rather than relying on external authorities. The composite operator operates in darkness, preferring that you remain ignorant of his methods. The moment you shine the light of understanding on these methods, you neutralize much of their effectiveness against you. You may never accumulate the capital to operate, as the large interests do, but you can certainly avoid being their victim. The truth is simple: markets are readable, crashes are predictable, and your financial safety depends on learning to interpret the signs that appear before every major decline. Stop accepting the lie. Start reading the tape. Your capital and your future depend on it. This is the path I've walked, and it's the path I'm offering to you. The choice, as always, is yours.